Hello, students. I welcome you all to this new and beautiful week. As you all know, this is our 8th week. This is the 8th week of this term, which is the third term. And this week we'll be looking at the topic that says methods of raising funds from the capital market. Methods of raising funds from the capital market. Ways by which we raise money from the capital market. Alright. It's expected that by the end of the lesson you should be able to define capital market, list the methods of raising funds, and then explain those methods listed. Let's start from defining capital market. I know that we defined capital market some time ago when we treated financial system, but because of the topic we have today, we have to do it again. Capital market is a part of financial system. Financial system is a system that allows the exchange of funds between lenders, investors, and their borrowers. A system that allows the exchange of funds between the lenders, the investors, and the borrowers. I would say that capital market is a part of this system which is concerned with raising capital by dealing in shares, bonds, and other long-term investment. When we talk about shares, like we know, is a unit of a capital, and bond is a fixed instrument that represents a loan made by an investor to a borrower and other long-term investment. Here we have the methods of raising funds in the capital market. The methods of raising funds in the capital market. The first one, if you look here, we see we have about 8 of them here. We have public issues, private placement, obtaining term loans, right issue, offer for sale, venture capital, international issues, and bond issued by financial institutions. Now let's start from the first one, which is public issues. It can equally be called offer through prospectus. Offer through prospectus. Alright, this is a method of offer through prospectus. Like I said, it is also the most used method in the primary market to raise funds. It is the one that is used all the time. Every time you're hearing this company is selling shares, this bank is selling shares, come and buy. Do you understand? Here the company invites the general public, the investors, to invest in their company via another advertisement. The company will advertise advertise that they are selling shares. They will tell the investors, they will tell the general public to come and do or to come and invest in their company by buying shares, and they do that through a means called prospectus. The prospectus is the document you send out when you want to invite public to come and invest in your company through shares. All right. And the next one we have there is we have right issue. Right issue. Right issue is generally when a company is looking for an expansion, when they want to expand their business, already existing company, but they're looking for expansion. They want to increase the capital. They want, let's say, additional fund. They will do what? They will turn to their current investors. The first thing they do, instead of running out to the public again to come and call them to come and invest in their company, they do what? They first of all turn to their investors and ask them to come and invest more into the business, to come and invest more. So the current shareholders are given an opportunity to further invest in the company. They are given the right, that's why it is called a right issue. They are given the right to buy new shares before the public is offered a chance. Before they will start telling the public, "Oh, come and do this," they have to consult their current shareholders. This allotment of new shares is done on pro rata basis. It no longer be the price that it used to be. They have to reduce the price for them. Do you understand? If the shareholder chooses to execute his rights and buy the shares, he will be allotted to new shares. And then if they don't want, then the shares will be offered to the public. Do you understand? Now let's go down to the next one, which is what? Private placement. Private placement. Private placement. Now with the name private, you know that it is not for the general public. Public offers are an expensive affair. Sometimes offering to the public is always expensive. So that is why some companies will prefer to do or to go to to individuals privately, to invite some financial institutes like banks, insurance companies, and selected individuals to do or to come and invest in their company, instead of going to the public to invite them to come and subscribe for shares. Is that clear? And the next one is offers for sale. Offers for sale. Offers for sale. Now, in this case, offer for sale, under this method, instead of offering shares directly to the public, directly by the company to the public, it offers through the intermediaries such as issue houses, merchant banks, investment bank, or firms, or stockbrokers. Instead of going direct to the public, they will offer to the issue houses, they will offer to the merchant banks, they will offer to them. Then they too, after buying from the company, they will now start selling to the public. I know under this particular offer for sale is the sale of security take place in two stages. The first one is when the company will be selling to the intermediaries, and after that the intermediaries will then sell to the general public. That's the second stage. All right, now let's go to the next one, obtaining term loan. Term loan is a type of loan that comes with a fixed duration for repayment, a fixed amount as loan, a repayment schedule, as well as a predetermined interest rate. Example, a bank giving loan to a small business for them to obtain a fixed asset. Now a small business want to obtain a fixed asset. You go to a bank and ask for loan. Now the money will be fixed. They have a fixed amount, the particular amount of money they want. Then they will talk about the duration, how long will it take them to do or to pay back the loan. Now the interest, and then everything will be agreed before the loan is being given. So this is another means of doing what? Raising funds in the capital market, getting term loans. All right. The next one here we have bonds. Bond issues by financial institutions. Bond issues, like we said earlier, a bond is a fixed instrument that represents a loan made by an investor to a borrower. It's like a certificate. It's like something that we are seeing that represents a loan made by an investor. When someone that wants to do investment borrows money from someone, from a financial institution, the bond is the thing given, the tangible thing we are seeing. It has the details of the loan and its payment. And his payment method, if it's going to be paid instrumentally, it's going to be paid once, how long will the loan be, what is the interest rate, and so on. That is what bond is. So you can get bonds from the financial institutions. So let's look at the next one, which is what? International issues. International issues, borrowing money from outside the country. This one can only be achieved by big firms, very big firms. And sometimes you hear that Nigerian borrowed money from so country. That is, they're the ones that can only use this. A beginner cannot do this. Now let's go to the next one, which is venture capital. Venture capital. What is venture capital? This is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Now, when an investor see your business and think, there is something that will definitely come out of these people. It's good. It's better I go and invest. It's better I go and give them money to start up this business, because I know that in the future they will be great. Do you understand? So the person will bring money, give you as a loan, even though you pay back later, but because you're a beginner, you don't have collateral, you don't have anything. The only thing that the downside in this particular one is that the investors usually get equity in the company, and the investors always have a say. Let's say have a say. They will always have something to add, have contribution. Their opinion will always matter in the company. Why? Because the money for starting the business was actually theirs. All right. Over here, these are the methods by which you can raise money in the capital market. Now, as a student, you might plan in the future to do what? To start up a company with your friends. You have to choose from all these ones. You must not necessarily use all the methods. You can choose one. You can choose the public issue. You can choose private placement. Like they said, private placement is cheaper. You can choose right issues. But right issues, I think, is only when you must have started. It's not for beginners. You can choose offers for sale. Thank you very much, and then have a nice week. Thank you.